Dear investor, in this edition, we would cover the following: results and macros, global trade wars, uptick in private sector capex flows, and yes, valuations with time for alpha. Results and macros. Quarter one result season has started. Few large IT companies and banks have declared their results. The results have been in line or slightly below reduced expectations in case of IT. For banks also, results have been on the weaker side. Now, brokers have had a weak quarter, which was expected, while AMCs were relatively fine. However, market has been resilient with only small cuts seen on below expectation results. In the new tech space, there have been a few results in an EMS and new tech spaces where execution was better. The outcomes on the market has been good. This points to strength in the market. Now, as far as macros goes, economic momentum seems to be sustaining. Both the services and manufacturing PMIs recorded strong readings in the month of June 25. Crude prices continue to be below 70. INR has been stable. Forex reserves have come close to all-time highs, and trade and current account deficits are in control. In fact, in quarter 4, the country recorded $13.5 billion current account surplus, which is like 1.3% of GDP for the quarter. Precious metals continue to hold strong. Now, global trade wars. This is the topic of the season. The past period was witness to rollout of duties for several countries by the US. Mostly, the duties were lower than April 2 levels, and in some cases significantly lower. Indonesia settled for 19% US import tariffs, while Vietnam would see 20% import duties on its goods and 40% on transshipment. Meanwhile, Japan has also got a deal at 15%. US has indicated that a potential Indian deal could be on the lines of Indonesian deal. With more deals happening, we know where the range of expectations would lie. There have also been indications that the US aims to decouple from China its economy. It has proposed higher import duties on battery chemicals sourced from China, for example. Also, US wants to encourage production of solar cells and panels in the US and has proposed an import duty. Now, Indian battery chemical businesses and solar businesses which have manufacturing in the US are well placed. Overall, duties should only modestly change the competitive advantage that one nation has over the other. They are not expected to materially alter the trade dynamics in the short term, is our base case, while time will tell once the outcomes are out. While China plus one sentiment is strong, moving away from China is not easy. While some contours of the Indian deal may be known by the time this video gets to you, it will be out on 1st of August. It should be neutral to slightly positive for the country's ability to support labor-intensive manufacturing for the US market. Duties on pharmaceutical is another area of interest to us. If we look at our portfolios, our linkage to external facing businesses is very low. We have a solar company which has manufacturing in the US and a chemical company which may export battery chemicals. These exposures are well placed. We also have a exposure to cables, an area where India has demonstrated export competitiveness. We would have to track this space for final outcomes, but barring a no deal scenario, the impact appears manageable based on current information. Our deals with UK and EU are progressing well. The deal with ASEAN, which has not been favorable for India, is sought to be renegotiated. If we are able to improve the terms of trade, it would provide a meaningful support to the Make in India initiative. In any case, the sentiment to de-risk from a single country risk works in our favor. Private sector Capex is picking up. That's the next topic. After a long while, corporate Capex is picking up. Corporate Capex for the listed non-financial space breached 11 trillion rupees in financial 25, 20% growth YOY, thereby outpacing the central government Capex which was at 10.5 lakh crores. Financial 25 corporate Capex spending pattern saw broad-based growth, wherein 157 corporates embarked on a Capex of greater than $100 million, which is the highest number since 2013, based on publicly available data. Public sector corporate Capex grew 26% and it outpaced private sector capex growth of 18% in financial 25. Now, government fiscal deficit is expected to reduce further to 4.4% of GDP, and this we think will not pressurize credit markets for funding private capex. Also, despite a falling fiscal deficit, the 6-month government capex reached a record 7.5 lakh crores, supported by back-ended financial 25 and front-ended financial 26 expenditure. Even though the budget outlay was underwhelming at 11 lakh crores. Contrary to expectation, government capex has continued to be strong. This early capex deployment may lead to potential upward revision in the financial 26 budget estimate, as was seen in financial 25 revised estimate. Now, monetary policy remains focused on supporting growth since December 24, when the first CRR cut of 50 bips was announced, followed by a slew of measures to boost liquidity in the system, including another 100 bips CRR cut to be implemented in tranches over calendar 25, and 100 bips of repo rate cuts implemented in calendar year till date. Now, corporate capex related credit could see acceleration. One of the key reasons for relatively slower, despite rising capex growth in the recent past, has been the elevated cash flow from operations generated by the listed companies, for example, versus capex. This hit a cyclical high of 2x, greater than 2x in financial 21. This has been falling. CFO to cash flow from operation to capex ratio has dipped to 1.5x as capex growth is improving and outpacing free cash flow from operations. As this trend continues, this could eventually support a pickup in corporate loan growth, though we see continued focus by corporates on maintaining low leverage on balance sheet. This is a trend that we have been observing. System-wide credit growth has been low, and a pickup in corporate capex would provide some support there. Coming down to flows, after Jan and Feb, which saw strong FPI selling on higher US bond yields, weaker INR and portfolio shift away from China, calendar year till date, other months, except Jan and Feb, have seen FPI turning buyer. This trend appears to be supported by a more stable INR, softening bond yields, a weaker DXY, and ongoing trade developments which could offer incremental benefits to India. Amongst emerging markets, apart from India, only Brazil witnessed more consistent FPI flows during this period. Inflows after Feb have largely offset the outflows witnessed in the month of Feb. However, the Jan outflows of approximately US dollar 8.5 billion remain unrecovered. July is again seeing a modest outflow. The mutual fund inflows picked up somewhat in June after showing signs of weakness over the past few months. We sense July is being stronger. While flows have been there, IPOs, QIP, P sales and promoter blocks have been absorbing liquidity from the secondary market. We had said that we should expect a period of consolidation in the market on this count. Companies with stable shareholding and no immediate fundraising plan and delivering strong financial performance may be better placed in the market participation perspective, especially in contrast to periods of large liquidity event. While promoter insider selling is seen as a warning sign on valuations, we are seeing that much of the money raised comes back into the market after a short lag. This indicates that promoters may be diversifying their holdings rather than exiting equity markets entirely. The sales are also providing a fillip to the real economy. Some bit of the money raised also goes into, for example, real estate. Same effect is seen in P sales, where monies are returned to investors and again a new fund is raised. We think this activity is self-balancing and prevents bubble valuations from getting created. Coming down to valuations and why we believe it is time for alpha. Now, valuations have undergone a correction. Nifty is barely changed over past 1 year, while earnings have expanded by 8%. This points to a significant valuation correction over past 1 year. In a period when interest rates have declined and liquidity has improved, this is notable. Markets like Korea and China have done relatively better. This is surprising given the export intensity of these economies and the global trade headwind. Even during the past 3 months, India has performed lower than Korea, US, Taiwan, Indonesia, Singapore, and Japan. even over 6 months, Indian market performance has trailed most countries. Now, given easier liquidity conditions, lower cost of capital, and valuation correction, these factors may provide a constructive environment for markets going forward. These conditions prevail globally and are tailwinds for risk assets. We continue to believe that there are opportunities for differentiated performances at a stock selection level. Last quarter results showed relatively higher earnings growth in some of the newer segments we are exposed to, while IT, banks, commodities, staples, etc., which are better represented in the index, witnessed slower growth. We expect an encore this result season also, and hence, with a thought that market follows earnings growth, we believe it is time for alpha. Thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.